Hello, it's a pleasure to host the last webinar of the year for Baltic Horizon Fund, and very much look forward to give you an update on the fund and its performance. So as usual, I'm planning to have a presentation for about 40-45 minutes and then have around 15 minutes for questions. The presentation will be divided in three parts. The first part will focus on the financial results and the key highlights of the third quarter, but also the entire year so far. And we'll continue with talking a bit about the properties and how they have performed throughout this year, and of course at the end focus more on the future and talk more about various commercial real estate segments and how do we see them at this point, and what are the major trends there. So let's just kick it off. So just to reiterate what Baltic Horizon is, has been, and will be, we are focused on strong investments in the Baltic capital cities, and our priority is to manage those properties, manage the tenant relationships, attract strong tenants in the market in order to pay out dividends. And dividend is our priority. We are a quarterly dividend payer, have been also this year, and we are paying dividends from the operating performance of the properties, and our payout target is at least 80% of the operating cash generated from rental activities. We believe we have grown to have a diversified portfolio across Baltic capital cities, and we're also quite actively traded on the Baltic and on Tallinn and Stockholm stock exchanges. We have about 153,000 square meters of quality lettable space in Tallinn, Riga, Vilnius, and about more than 5,000 investors from this and northern side of Baltic Sea. The dividend that we have actually paid out this year is not as high as last year, as of course due to pandemic we have been forced to give out some discounts to the most affected tenants, but also that we have created a dividend buffer in order to defend maybe the financial position a bit longer for the fund, and be able to take advantage of potential opportunities in the market. And we are also rated by Standard & Poor's since 2018 and have an MM3 rating. Key changes, if you compare to the year end 2019, then we had valuations done in June, and the portfolio value dropped approximately 3.3%. We had, because of that, a slight increase in the loan to value, and our NAV had dropped because of this by 9%. So it stood at the end of September at 1.22. That is by now a bit lower because of the dividend payout, but it is still very close to 1.2021. In regards to the net rental income, actually year on year we've had growth. The growth has mainly come from the new acquisitions, and to some extent a little bit also from the increase in some of our office properties rental income. The net initial yield has dropped slightly this year, and this is also again a result of the valuations. and is mainly to do with our larger centrally located shopping centers, which have been impacted by the COVID lockdowns and lack of tourists. Still, one should look at the valuations as a good sort of estimation of value at any given point of time. We don't plan to sell any of our properties today and do foresee still very much long-term potential, especially in our centrally located assets, and therefore are also now working towards recovery of those values, even though it is likely to take some time. Notable events, again, to re-emphasize that despite of the difficult year, the fund has remained cash flow positive every month, and we have not breached any covenants. So I think big thank you to the team that has managed tenant relations, again, especially in our few larger shopping centers, and managed to find good compromises with the tenant base, and been able to also help some of the tenants, especially in Lithuania, to get government support in order to pay the rental invoices. In the springtime, the government support in Lithuania was especially dedicated for tenants to pay their rent, no other expenses, and I guess considering the circumstances that one is forced to close their stores and forced to close their shopping centers, this is the only reasonable way how to get through this together. In regards to the Standard & Poor's rating, we had it affirmed at the mid-market level, the same number 3. And then we continued in third quarter, especially in July, August, when still many of the discount negotiations were only then finalized. So we have actually continued these discussions up until August, majority of the discussions with the most affected tenants, in order to make sure that we get all the government support measures. So a lot of the also the spring discounts were only recorded and adjusted in the third quarter as well. Still, we had seen some quick recovery, especially in August, September, in our shopping centers. But of course, by now, by November, we are back again fighting with the second wave, and we have seen also the visitor drops and also turnover drops. So we are once again, having discussions with some of the tenants that would need our help, but also how governments can support them. But nonetheless, we decided in October, when we had the time to make a decision for a dividend, to really thank our investors and reward them with a slightly higher dividend than we did in the previous 2 quarters, because we still had and still have a dividend reserve of 3 million after this payout. And I think another definitely important event in the third quarter and especially in October was that we were preparing for a public offering, given the difficult circumstances, in order to have dry powder to take advantage of the opportunities in the market, but also prepare and invest into our expansion projects, in order for us to be ready to welcome new tenants next year, when the pandemic will start to hopefully then stabilize. Something that I would like to emphasize again is that our team's hard work on really working on the sustainability benchmark of Baltic Horizon, and when we adopted GRESB, which is a global real estate sustainability benchmark valuation, when we adopted this in 2018-2019, then we discovered that there's a lot of things that we can do in order to improve not only the environmental footprint but also social and governance aspects of the fund. And this really involves not only having energy audits done on the properties and looking for low-hanging fruits where small investments can be done in order to make the buildings more efficient. Also long-term investment plans for the properties where it's reasonable, but also what is the social aspect with our tenants. So we have introduced tenant satisfaction surveys, or have introduced more data analysis of how our tenants have been doing. And this was not because of COVID, but also because this is something that we already started in 2019 and found the ways how we can really improve the situation. And of course, not last but not least, governance aspects. What sort of policies we have in place, and how we can still complement our policies, sustainability policies, have targets, and all these things clearly written down. So I think we made some solid improvement, and we're looking definitely to further improve our score in the coming years. So more specifically about financial results up until end of September 2020. Generally, the results were positive. They could have been even more positive, but due to discounts that we had to give, they were a bit less. As I mentioned also in the quarter report, we estimate that approximately 10% of the net operating income will be lost for the portfolio this year. Maybe a bit more now, considering the further restrictions in movements now in December. But I think overall the team has really managed quite well, and our office properties have been also doing very well. In regards to the numbers, we did record a valuation loss in the middle of the year, and this of course affected the total operating performance, but net rental income still is very positive, and cash flows are still coming in at the fund level. Of course, with city center properties, we have to manage separately, tenant by tenant, and we hope to really come back from this during next year. But as it seems, the quick recovery is that we all hope for has turned into a longer term recovery, and that will definitely still be ongoing next year. But I think our overall aim is of course to manage the pandemic and open the doors of our shopping centers not only to the locals, or keep them open, but also tourists that are hopefully coming back at the end of next year. Otherwise, the balance sheet looks quite straightforward. Maybe just to draw your attention to trade and other receivables by end of September. The receivables that we had from the tenants were managed to actually be at a very similar level that we had in 2019. So by that moment, all the agreements that we had reached with the tenants were respected, and payments were made. So managing tenant relations, especially during these periods, is not easy, but definitely I think the team has done a good job, and would look for a brighter future now. When it comes to cash and cash equivalents, then that has by now increased by roughly I think 4.5 million. Some of that cash was from this line was paid out as dividends, but the current cash balance is even higher. And this, I think, is one of the most important slides for us. What we also monitor as fund managers, and I think every investor should keep a very close eye on this. This is actually the net generated cash flow every quarter, and how that has evolved, and I think the difference here is still the in Q2 and Q3 compared to Q1 is the temporary discounts that we had to give to the tenants, but also some unearned rent from some vacancies, increased vacancies in our shopping centers. But overall, we are cash flow positive from operations, and this is a line as well based on what we are really looking what sort of dividend we can pay out in the upcoming quarter, and if you look at the market price, then we have the 12 months rolling dividend yield there as a last row. So this is the dividend yield we have achieved based on the respective market price at the end of that respective period. And we still have the cash flow distribution reserve of about 3 million, which at the moment we intend to keep as a cash buffer. So again, the same information in more graphic format. Cost of debt for us has been fixed and hasn't really changed much. We've had some increase in the LTV, but I think that's been quite small and quite normal. When it comes to our financing partners, then of course we have been in close contact with them throughout this year, and it's been quite a good dialogue. The banks have been quite understanding, and have said that if there will be any breaches or any potential even breaches, then at least for the period of until middle of next year, they are willing to look favorably upon these changes if there will be any. Our cost of debt has been fixed to a high degree, so there's no changes there. And we're looking only to refinance some of our loans, mainly at the second half of next year, and mostly in 22-23. And in addition to our financing partners, the local banks, and SEB, Swedbank, OP, and Luminor. Luminor has been actually very active in the market lately. I think it's been a good sign to see that there's been an active player, added, whereas last year it was also only the SEB and Swedbank mainly financing commercial real estate. So that's been a positive change this year, what we have seen. So let's see if we can go forward. Yes. So about 83% of our interest has been fixed, and we do have a bond as well, a bond with a coupon of 4.25%, and also had a dialogue with bond investors where they were willing to adjust the equity covenant until mid next year to sail through this uncertain times together. So these are quite rather standard slides, and they change somewhat over a quarter, but not so much. I think something to emphasize here is that we're quite well diversified across the 3 countries, with maybe a lower allocation today in Estonia. Our office segment rental income is about 55% of the total income. 40% is an income from retail properties, and around 12% of that income from retail properties comes from neighborhood supermarkets. Around 27-28% comes from the centrally located assets, Galerija, Europa, and Postimaja. So as you have also noticed, you know, really the key aspects of this year has been that people have been more homebound. They have been mostly living in suburbs, even though many people did come back to the offices after the first wave. But neighborhood supermarkets have been doing extremely well. So have our properties, Sky, and especially Sky and Pirita, compared to last year. And Domus Pro in Vilnius as well has held very strong. We even had new tenant there, a new outlet tenant move in just recently. So again, Domus Pro is fully let, and when it comes to the office premises, then compared to last year, we were able to fill the vacancy in G4S. So there was improvement year on year especially in G4S, but also in Duetto, where the vacancy was filled. So overall, the office segment, yes, has done quite well. Maybe some numbers. When you look at the second and third quarter, which is 6 months, then we recovered from the retail sector. We recovered 73% of the rental income that we had budgeted, and so we had, of course, major discounts in larger shopping centers, but I think still we've done quite well. Our team has done an excellent job in that way around. And in office segment, we have recovered more than 95% of the budgeted rental income. So what was where we had to make some discounts mainly was in the cafeterias that we have in each office building, and due to the pandemic, they had to be closed for a while and had very slow recovery afterwards. In regards to the running yields, generally you can see again the same thing in numbers, that we've had some increase in vacancies, especially in Galerija centers, compared to last year when we had an occupancy around 95%, and also a decrease in occupancy in Europa. In Pirita, we still have some vacancy to fill, but that has actually improved compared to last year. And we have also improved vacancy or occupancy in Upmalas Biroi now by 1st of December this year, the property is again fully let, 100% let. In regards to Postimaja and the cinema, we're fortunate enough at the moment that the cinema is open in Tallinn. It's not as restricted here as it is in Lithuania, and as we know today, from tomorrow the lockdown will again be present in Vilnius, and in Lithuania it's quite a harsh lockdown, and it's a lockdown of as well commercial properties, especially shopping centers. So Europa and Domus Pro will be affected in the coming months. We don't know yet to what extent, and as well what will be the government support measures like there were last year. Last year the government support measures were quite sizable, and we definitely hope that and expect that there will be some support measures also this time around. Unfortunately, we have to manage the situation from our side, and rest assured that we will do that. Some positive, I think, news also. What we've been working throughout this year is on our shopping centers and on the management of our shopping centers. So we have introduced new team both in Europa Shopping Center and in Galleria centers, where we have new center managers taken over now in November, and I think there's definitely a lot of great ideas and great ambition to work with the tenants and bring these shopping centers through the crisis, which we are again facing now, especially in Lithuania. But I think more about that in the later parts of the presentation. It's the future of both of our segments, office and retail. In regards to, I think maybe one comment about the low direct property yield in Q3 for Postimaja is because of the one-off discounts that some of them were also not related to the COVID, but actually were write-offs from the last year. So they all happened in Q3. So that yield should definitely improve in Q4 and then in the later quarters. So now getting into the discussion of where we are today, and the investment market throughout this year has actually remained quite active, and many of the investors that had plans to acquire properties in the beginning of the year, they took some time out during the spring, but then quickly resumed their investment processes in early summer. So there's been quite a lot of transactions still in this year. Probably we will not reach the same level of transactions as last year, but I think we will be quite close. And there's been transactions in all segments, especially in office segment, which has remained more resilient, or most resilient, and logistics has emerged as one of the favored segments. And also there's been transactions in retail in Riga and in Vilnius specifically. For us, when we finished last year, then we had achieved our strategic target to have a centrally located shopping center in each of the Baltic capital cities. And in order to be able to offer new tenants that are entering the Baltic states on a long-term horizon, sort of a selection of the location in all three capital cities. It's been unfortunate, of course, that this type of crisis has temporarily affected these centers because of course lockdowns applied to retail centers, but also lack of tourists this year. And but the investors have been definitely on the buy side. Only a few have been selling, and I think the capital that is in the Baltics is still very much from the Baltics itself, Scandinavia, but more and more also wider international capital coming from mainland Europe and even abroad, from South Africa and to some extent the United States as well. And there are also Asian investors lurking around, but we'll have to see when exactly are they making their first investments in the Baltic states. When you talk about retail, then this crisis has been quite supportive of the retail centers in the neighborhoods, and because people have been pushed to their homes, and I think what we have seen is record low vacancy levels in the Baltic capitals. You know, they have increased now somewhat to the levels of 3-4%, where they used to be, you know, basically 0 to 1%. In Vilnius, the overall vacancy still remains quite low because of the existing retail space, which is per square meter or per capita is still lower than in Tallinn and Riga. I think we will see some vacancies increasing now over the next 3 to 6 months, depending on the government supports. But I think we are definitely in the second wave, and we'll hope that these numbers can be contained. But as we see now in Lithuania, they have, in order to really contain these numbers, so they have introduced very hard measures, also on movement of people, and this will definitely affect the vacancies in Vilnius in the coming period. There's also an interesting graph here where we have shown the footfall of all of our shopping centers, and as you can see, the star performer is Pirita, which is again in the middle of the neighborhood. We have brought in some new tenants there, and very well we have also Sky and Domus Pro perform throughout this year. Again, neighborhood supermarkets, shopping centers. And regardless that the footfall has dropped somewhat over the year, the actual average check, of the person, of the buyer has increased more, so that the turnovers seen in these centers is much more stronger than in our 3 shopping centers in the city center. Maybe you can probably imagine where this trend will now go in December and January. So we will face a slower recovery than what we originally expected. But if you want to look for some positive moments, then one of them is that when the lockdowns were eased up, then the footfall and the turnovers of the shopping centers, as you can see in June, July, August, September, recovered quite quickly. And people want to go out, they want to shop, they want to experience things, and this is just of human nature. What has been missing for us, as you can see, is the tourists, and the tourists making up that 20 to 30% of the turnovers in our centrally located shopping centers. But that gives at least hope for the spring, that or early spring, when the second wave will be contained, then the recovery should be quite quick. Now, if you talk about retail in general, and that's what we have also been thinking about very carefully, and of course, one thing is for sure, that online shopping is increasing as as a way of doing shopping now. Everybody's doing online shopping during Christmas time. Even though, yes, many people are also saving money rather than spending it on anything that they would like to have. But I think this is something to consider as a shopping center owner, that people, when they're still social beings, but you can think that the person will live its own life only at home, do shopping at home, do office work at home, raise kids at home, do homeschooling. So but this is not realistic, and what people more and more will be looking for in the future when visiting shopping centers is definitely the environment. And when we are looking at our centrally located shopping centers, then that's exactly where we are, where we want to be once this lockdown and the second wave is being curbed. That we would be ready to really provide not only the tenants but customers an environment where where they would feel excited, where they could mingle, and where they would also like to spend time in. I think that's what every shopping center owner needs to think about: is interior design features, and not just being a white box with goods, because that can be very well and very easily ordered online. It's about I think more cafeterias, it's about the pickup points, it's about customer service, it's about technologically advanced stores where one could try on for example shoes and have them then shipped home. I think that's definitely also the future, that people still want to touch and feel. Some people are quite tired of or let's say it's not working very well, and it's not sustainable if all people are ordering 5 pair of shoes and then sending 3 pair of shoes back. I think it's cumbersome for the customer, but it's also very cumbersome and expensive for the retailers. So we see more and more concepts opening that one would go to the store, have good service, try things out, and then have those goods shipped to their homes. So that's what we call the omni-channel way of retail for the future, and that's exactly the sort of tenants we would be looking for, to fill in our vacancies. We are planning some investments, and we, as you know, the Postimaja project has been long in preparations. We hope to get the building permit still this year, so hopefully there will be some news coming out. But I think again our focus is to really create a exciting and comfortable environment for the visitors, that they want to come there just if it's pleasant, and the other thing which definitely we're focusing on for the future of retail is having mixed use, that you have diverse functionality. People not only come there to shop, but they also come there to maybe see a movie, to go to office, to go to a restaurant, to go to a health club, practically do everything in one place. And we have one definite success, which is Domus Pro in Vilnius, that has a very wide tenant mix, and it really performing well. And these are the definite directions we want to take with Postimaja and Europa, and also with Galleria. And work is in progress there, to establish first a food court in Europa, ground floor, also larger food court in Galleria, a new health club, potentially also some co-working spaces. So this is definitely the future of our centrally located retail properties. Then a few words about the office segment in the Baltics and how we see it. I think overall the office segment has been growing quite rapidly over the past years, and And this vacancy number in Riga, 18.5%, this is a bit distorted because there is this one property called the Z Towers, which have been left mostly vacant by the will of the owner because of their expected very high rents. So if you take that out, then the vacancy is similar to Tallinn level. I think the vacancy in C-class offices will continue to rise, and tenants that, especially now post-COVID, are looking for custom-made solutions, new layouts of the office premises, and that's something definitely will be the future of the offices. Tenant layouts will change. Also the flexibility of people, working from home. I think the main question in our heads and I think many investor heads is that what would be the economic impact, after this second wave, and how much government support can again sustain, relatively acceptable levels of GDP growth, but more importantly, employment, and that's also in the minds of our office tenants, and many of them don't know themselves yet, how the future will be, and how much changes will there has to be made, in the layouts, but I think everybody is thinking of efficiencies, and the different layouts, that there will be a very specific area for co-working, there will be a specific area for team building, team working, and areas where one can also spend time in a more freer format, so that the office sort of gossip or what you may remains part of the culture. I think many office tenants are worried about the people's efficiency also working from home. So it has raised quite a bit of challenges throughout this pandemic. But again, this pandemic is not it's not going to be the same as it is during the pandemic. I think it will be somewhere in between. In offices there will be allowed more flexible working, for example 4 days in the office and 1 day remotely. I think there will be more clearer planning of teamworks and potentially also rotating of various teams. So of course, the safe environment, the focus on materials and good ventilation is definitely a must for the future. And I believe as well that in every office building in the future there will be at least one floor that will be a flexible space for all the tenants to use on a more of a temporary basis, so that the flexibility has really grown to be important for the different tenants. But that's definitely an opportunity for office building owner as well, because when you have flexible space and let's say co-working space in your office building, regardless if it's in the central area or in the suburbs, then one can also rent these premises out to the neighboring areas, neighboring catchments, where more people will be maybe working from homes, but still needing space close by for team meetings. And I think that's definitely what we're looking into is how to accommodate that also technologically quite easily for this demand, which is coming from outside of an office building and outside from the current tenants. When it comes to the location question, then of course nobody can really know at this point. And what we've been discussing is that I think in addition to the downtown offices, there will be more hubs in the suburbs where office workers are either gathering to go to everyday work, or then just ad hoc to have a place to meet. for teamwork, for conference calls, and all the rest, because you wouldn't do a teamwork most likely from home, especially if you have a family and other limitations. So I think the future of offices will definitely be there. It's a question of I think flexibility. Definitely, it's a question of the level of demand, and human contact is definitely still very much important to maintain trust, to maintain efficiency. I think we've all seen that playing telephone games is quite sometimes quite inefficient. And ad hoc information, doesn't spread as quickly as it would in the office. So for some tenants, it's especially important. We have one tenant in Riga that actually has increased space during this year, and this is because of their long-term future plan to bring more departments and jobs to Riga from the Nordics, and so this is a trend that we continue to see happening, but maybe not so quickly as previously envisaged. But I think as well that one would be worried, I think, in Stockholm and Helsinki right now, where they have 5 or 6 times more office space than we have in the Baltics per capita. So I think we're still a growing market, and especially what will be valued is newer office buildings with good certifications and efficiencies. The future of logistics is definitely something to discuss as well, and logistics has been a tricky segment. It's been growing and it's been an attractive segment, but I think in logistics, what the main risk is, of course, that the buildings that are being built or have been built will be obsolete or have to completely be rebuilt once the 10-year usual lease agreement finishes. And as well, it is very easy to copy paste logistics centers and build better ones. So sort of the devaluation of the property or amortization of the property is really written into it. Even the location doesn't really help it. But having said that, when you have a well-built logistics center, and especially in closer to now, more and more closer to the urbanizing areas, then it's definitely an asset class that is attractive. And we're definitely also now looking into this, but haven't found the right investment yet, also in the past years. But what we see is the future of logistics is more decentralization, meaning that people, when they order online, they want it delivered as quickly as possible. So there will be these small, what you call maybe downtown, warehouses, or that will be the allowing that quick delivery for the people. And as you know, in the Baltics, all the shopping centers is 15-minute drive away. So one would always think that whether I can order something online and wait for a couple of days, or then buy it in 15-30 minutes. So if they bridge that gap, then that's definitely also boosting, I think, online sales in the future. But the logistics is definitely here to stay. Of course, robotics will be more, automation will be part of the logistics in the future. More skilled staff will be working in these logistics centers, and that's another reason why logistics centers are more and more moving into more efficient, maybe not so huge spaces, but smaller spaces, sort of midway storages inside the city, and very technologically advanced systems, allowing maybe 1 or 2 people really manage the warehouses efficiently. And of course, we're all moving towards zero carbon construction and building, and before I mention the things about the care homes, then we have also a plan now during the next year to certify all of our properties with BREEAM, either very good or excellent. So that's in process, and for our office buildings should be completed by the second half of next year. And when it comes to elderly care homes, then it's definitely an attractive segment, and it's a question as well of what sort of properties are there, like in logistics segment, that there are only a few really built to suit properties and new properties in the Baltics that an institutional investor can buy. Of course, there is always an opportunity to take additional risk and operate the property, basically with new formed companies and take a development risk of developing a property. So that's also something of a possibility. But this trend is something that we're looking at very closely, and we are searching for opportunities to buy elderly care homes, preferably in the capital cities, where the purchasing power is the strongest, and as well the location, in our opinion, with the most resilience. So what we face now in the Baltics is we have a lot of renovated older buildings, and actually some of them quite successful. So the demand is growing, but the question is that what would be the property that would be valuable also 10, 15, 20 years from now on. And of course, financing has been an issue, but I think in addition to banks, we have debt capital markets quite active, especially this year. Many companies, real estate development companies, raising money through bonds. Bond is a very attractive mean and an instrument for Baltic, especially for retail investors. So we are definitely seeing more and more of that. So I think maybe to summarize here is that the money is definitely there. Money, preferring bonds, but also equity. Future of the real estate, I think, is still very strong, and given the money printing that is happening, that money will have to pour somewhere, and it is likely to be equities and real estate, as they say, and as we also believe. So maybe to finish up with the target of Baltic Horizon for the next 3 years, and to summarize what have been said throughout this presentation is we definitely believe in the future of our centrally located shopping centers. We are converting them to be more of mixed-use buildings, and adding different functionalities and upgrading the functionalities that we have, for example, food courts and gyms, but also seeing if we can add a co-working space into the mix. We do believe that the tourists will return. As mentioned also in the quarter report, the recovery of I think city centers overall will probably take 1 or 2 years in the Baltics, depending on how quickly the vaccine is administered and how quickly let's say these restrictions are being eased up, set by the governments. I think we definitely believe in the future of office, and one would have to work out with the tenants what would be the favorite layouts. The growth of the office segment probably will not be as quick in the next few years, as office tenants will be also looking for efficiencies. But I think the growing segment will still be there, and that's where we want to focus more and more on. But I think more importantly, is the other segment that we are considering here at Baltic Horizon, and definitely considering logistics and similar properties. And definitely aged care homes, where we see the long-term potential, also solid dividend potential, and over the coming longer period of time. And when it comes to the diversification that we have currently, then we want to increase the diversification more towards Lithuania. Of course, still having a balanced, relatively balanced allocation country-wise. But since Lithuania is the most largest, especially Vilnius, the largest office segment, and definitely still growing, because per capita the office space is lower than in Tallinn and Riga still. However, yes, for the upcoming year or so, the office developments that haven't started yet, they will probably be postponed because of the tenants are taking maybe more time to decide what would be the future layouts. Maybe last but not least, we're definitely prioritizing our planning of our shopping centers, conversion or upgrading into the next decade, which is, as I mentioned, Postimaja, Europa, and also Galleria, where we want to also build on top the terrace and the food court. But we have one property under construction where we have about 20% leased out, where we're discussing with the tenants exactly the same things. What would be the future layout requirements? And that's being built next to the Domus Pro complex, and which will after it's finished will I think be one of the most diversified tenant mixes that we have in our portfolio. As we have in Domus Pro, the gym, the office part already, food outlets, we have the restaurants, we have the food store, and we definitely want to add more office mix into this. So all right, let me try to answer some of the questions. What would be the comment on the new acquisitions next year? So we are working on one acquisition, actually, having due diligence, and maybe cannot reveal more at this point. But when you saw our target asset class mix, in the future, then that's where we are already moving towards. And as Meraki office expansion is also in the office mix, so that's definitely a segment that we continue to look favorably upon. And in addition to one specific project in due diligence, we have, of course, many other discussions with the property sellers, and there's a lot of properties for sale, actually. So trying to make a good deal here. So we talked about working from home. I think what we believe in, and this is not just our own understanding, but based on what we've discussed with tenants, with some of the major tenants that we have, that the future of office segment, yes, will entail some flexibility, but when it comes to especially the tenants that we have in our portfolio, larger tenants, international tenants, then the wish of the employer is still to have employees work mainly from the office. But I think the flexibility comes where you know, there is more work which requires focusing or requires you know, some work, you know, that can be done on a private basis, and this will be allowed more and more to be done from homes. But again, you know, a reminder is that at the moment there are only about 20% of employees have a dedicated workstation at home or a room, and 50% have actually a work table, but the rest of the 50% are working from, you know, sofas and kitchen tables. So it's also the question of what is available at home, and employers are definitely reluctant to invest into working stations at home. So I think it will be some flexibility. Yeah. All right, we have some more questions here. Resources allocated to sustainability work, long-term ambition level with regards to ESG. So we have an ESG policy which we are continuously also updating, and maybe to quickly go back to this page, we have a dedicated ESG specialist within our team, and together with, it's a lot of analytical work, it's a lot of I think work with documents, but also work with understanding, you know, from the property managers what can be done to improve the ESG sort of aspects. And our goal is to you know, get additional star from GRESB, for example. Every year we have now 2 stars. We are very short of obtaining 3 stars, but that's definitely the goal. I think the level of communication with the tenants can be definitely still improved. We are looking to, especially with our centrally located shopping centers, which, as you know, some of them are older buildings, you know, historic buildings, and we're looking for ways how to improve the energy certificate level, at least by one level over the next few years. Then I mentioned we're targeting to have BREEAM certification for all of our office buildings by next year. Very good or excellent. And I think also the neutral carbon view is more of a long term for us. Definitely we have communicated that it should not be later than 2030. And the way we also manage you know, our portfolio is the acquisitions that we will make in the future will have to be already certified at a high level. That's why we're also you know, expanding Domus Pro and building Meraki, because that will be the definitely the most modern office building in our portfolio, but also one of the most modern in Vilnius today. So these are definitely the routes that we're taking in regards to ESG. All right. If there's no more questions, so we've had a good session for about an hour, and I think what will happen today is we will send out the NAV announcement for November, and I think we have one last question. are we able to increase our investment rating to reduce our interest cost? That's a very good question, and it's definitely something that we have been working on, and we have from Standard & Poor's we have the MM3 rating, which is just below the investment grade, and MM2 or BB B will be already investment grade. We have discussed this quite extensively with the rating agency, and I think in general terms, what we've understood is that we need to grow as a fund and target modern centrally located properties as investments, and continue basically doing what we have done so far. Also increase the diversification, but what is let's say what is basically hindering us from getting investment grade rating today is definitely one is size, and I think there's that's really the main consideration, and we need to keep the quality of our properties and that we acquire, and that's why our focus is definitely on new properties, new office buildings, new logistics centers for the future, and hopefully then we will be able to obtain investment grade rating, and by 2023 when we have a lot of refinancing, we'll be in a very good position to refinance our debt portfolio and potentially also consider options from capital markets, because it is true that with the money printing, a lot of the cheap money, very cheap money, will be flowing again into investment grade products. And we have one more question. Are we considering any sale of any property? The answer to that question is yes. We are considering the sale of Sky Supermarket in Riga in order to, I think, focus more on the larger assets that we have and really bringing them into the next level, but also increasing our allocation in the other segments and reducing retail segment, even though yes, Sky Supermarket has done quite well or very well during this year, and we hope to achieve that in the beginning of next year to sell the property, but those preparations have been already ongoing. Yes. So if there's any more questions, I'd be happy to answer them next time or over email. I think my email is well known. So thank you very much for attending, and let's look very much into the next year and manage now the second wave over the next few months, and definitely make plans for the future, long-term future.